Hello and welcome to the first chapters of CFA Level 1 Derivative Markets and Instruments. So, in this chapters, we'll cover these learning outcomes as mentioned by the CFA, which is the required learning outcomes. So, we'll go over the defining a derivatives and distinguish between the exchange traded over the counter derivatives. We'll also go over the contrast forward commitments, define forward contracts, future contracts, options, including calls and put, swaps, credit derivatives. We explain the arbitrage and for sure describe the purpose and controversies related to derivatives markets. So let's get started. So what is derivative? So derivative is nothing but think of this as a legal contract. So this is the legal contract. Basically it defines certain rights and what are the obligations for each parties, right? So there may be a two parties, let's say A and B, and they are in some bindings to do either buy or sell or certain things, assets. And then is these underlying assets can be anything like equity, bond, currencies, and so on. And this derivative, where underlying is the asset. So in this contract is written, okay, what is my responsibility? Let's say if this person is a buyer, and is a seller, and this is a seller. What the buyer should do, what the seller should do, uh, ba- based on whatever is written in this derivative contracts. So it will be more clear when I explain you, okay, there's some forwards, futures, swaps, options. So these are the different kinds of derivatives and once I'll give some example in the later videos or slides, then it will be much helpful. But in the general terms, if somebody asks, okay, what is the derivative, then these so derivative is, you can say, is nothing but just a financial instrument. It's another instrument that drives its performance. So performance based on the performance of underlying assets. So how this legal contract or this derivative perform, this is based on the underlying assets. So whatever is the underlying assets performances. So that's on the very high level review of the derivative definitions. Okay, so now this derivatives, now we understand a little bit on the derivative. So it can be further can classify into two different types. So one are the forward commitments. So the key is commitment here. Commitment is once you are in the contract, you have to the buyer has have to do the follow it. Or if you say, okay, I will. So these are can be three: forward, future, or swaps. Another one is type is the contingent claim, where we have option. Here buyer pays to have this the option, but the buyer get the rights but not the obligation. So buyer say, okay, it's depend upon the buyer. If the buyer think, okay, if things are in my favor, it seems profitable, then buyer of those option will exercise its right, otherwise it's not. But in these three cases, either is a forward contract or future contract or the swaps, there is no certain, there is no choice. These are the commitments. The structure of the derivative market, basically, so there are broadly two different market. One is the exchange traded derivatives, and you heard a lot is over the counter derivatives. So what's the difference between these two markets, where we see both the derivatives are there? So for first main difference is the terms and condition. These are more standardized, the exchange traded derivative market. For example, there is a set contracts are there that maybe for certain kind of instruments can only be expire on uh, Friday of, let's say, of March, June, December, or September, right? But let's say if I don't want Friday, maybe the as a buyer, right, or as an investor, I want rather than on the Friday, let's say I want on Wednesday. So it doesn't provide this the flexibility. Okay, the standardization is there, but in that kind of a flexibility or customization we'll see in the over the counter market. So over the counters market, there is no standard contracts. It's purely depend on the buyer and seller. They come together, and based on the specific deal they customize and made the contracts. So that's certain advantage, so so that's one differences. The another difference is highly liquid. Exchange traded derivatives is highly liquid. It's traded throughout the day, right? Because one reason is because of the standardizations, right? S- but these are not actually, I already repeated, so this should be here. So these are not liquid. So these are less liquid. The exchange traded derivatives are also highly regulated. They are more transparent. Because of the standard contracts we know what is happening. That's on the because of the specific in nature, their OTC are less transparent in nature, right? Because it's a little bit specific per deal and so on. Some of the examples of the exchange traded derivative which trade is, for example, future. So when we say future, these are traded on the exchange traded markets. But the forwards and the swaps, these trades on the over the counter market. So this is a few key differences between uh, the exchange traded and the over the counters. Okay, so let's say this is go to our first derivative. Let's start with the this type of forward contracts. What are these? So as an official definition mentioned in the book is the forward contract is an over-the-counter derivative. That's we also notice as per our last slide, in which two parties agree that one party is the buyer. Okay, so we have one party as buyer and will purchase an underlying asset from the other party. Okay, so there is some asset, as we know, derivative based on its underlying asset from the other party. So other party is the seller. Okay, so this is a seller at a later date at a fixed price. Okay, so there is some transaction going between based on this from one party to another party, that at later date fixed price, and they sign a contract. Okay, they sign. So maybe this can be let's say a stock, right? So let's say this is a stock. So this buyer says, okay, I will buy this underlying from you at 1 year from now, for example. In 1 year, let's say for one stock for $200, right? So one stock for $200, and seller says, okay, I will give you in 1 year, right, this one stock, $200 for one stock. And it can be, let's assume, any stock, right, one stock. So but good thing, one thing to note here is that no money changes hand at now. So now there is no money to change. It's just the agreement between. So when the contract is initiated between these two parties, these are the parties, right, the buyer and the seller. So there is no money exchanged. Okay, so let's take one example. Okay, so for example, uh, let's say what is the payoff or the value for the buyer or the and the seller. So what happened when buyer agreed to buy a stock from a seller at a forward price of $20? Okay, so let's say sometime in the future, buyer says, okay, I'll fix this price of 20, and I will come to you at certain time and buy this stock for $20. Then what is this? So this is saying this is ST, means at maturity. maturity of the contract, right? If the stock price there is zero, so then buyer has a loss. There's no value of $20, right? But if in the market stock price is, let's say, the higher 25, then the buyer has the value of that contract for $5. Similarly, the the if the value of the stock is $30 in the market, and the buyer has the value of 10, how come that? Because the value, so the buyer value basically is nothing but the stock at st stock price minus the forward price forward price. So this is the stock price. So basically, if this is zero, and if I minus this zero, I'll get zero. But let's say if my stock price is 30 at the expiry, and then if my forward price is $20, so therefore my value is comes here as $10. One thing you notice here, these are like a linear payoff. So if this is the profit $10 to the buyer, then the seller will lose $10. So this is equal. Here is plus, so it's minus, minus plus. So let's see with one graph how the payoff diagrams look like. So the forward contract, this is the payoff. So here I plot on the buying side payoff, and here on the selling side payoff. This line is nothing but the stock price. Let's say is a ST. Same thing here. This is the ST. Okay, and then this is the my payoff, which can be zero, or it can be positive, or it can be negative. So same thing here. Okay, in this one I think I forget. So same thing here. This is the stock price. Basically it's on this axis I mentioned, and then this is the payoff. So the y-axis is both for same for both. It's a plus and this is minus, but this is from the seller perspective and this is from the buying perspective. So let me highlight this with a color as well, so it's easy to see. So this is from seller and this is from buying perspective. Okay, so you notice if at maturity or at the end of the forward contract, if my price is as here, right, it's $20, and I know my forward price is $20, then 20 minus 20 is zero. So my value is zero. So my value is keep increasing here if for the forward contract for the buyers, buying side, if my stock price keep increasing, right? If this is increasing, my value is increasing here from this price, the forward price. But if the forward price is lower on this side, then I'm losing on the buying, because as a buyer the money it loses, for example, if it's 15, then I lose, then the buyer lose $5. If it's 10, then 10, and so on. So that's how it's. And if it's uh, basically 20, it's the value is pretty much nothing and it's lose $20. Okay, exactly the replica of the buying and the selling is, you notice on the selling side here. If you see, this side is replicated here, this is here, because if the buying side is making money, the selling side is losing money. So this is negative, which is shown here, because the money is basically, since it's a linear payoff, the money is just moving from one account to another. At these are the linear payoff from the seller to the buyer in this case. And if the price is lower, for show the seller payoff value is a positive here. Here this is a positive for seller side. So this is on the forward contract uh, payoffs. So hopefully you like it. In the next video, I'll cover more on the futures because this video is getting a little bit longer. So thank you for watching and see you soon in the next video.